Hello everyone, welcome back to my YouTube channel. Today we are discussing the Vietnamese Dong, exploring its recent market movements, looking at structural economic reforms, and providing a deep macro analysis of what is happening behind the scenes in Southeast Asia's most watched emerging economy. The news is that, according to leading securities companies, 2026 is regarded as a pivotal year for Vietnam's economy and stock market, marking the start of a new development cycle with a targeted GDP growth of 10%, deep institutional reforms, and strong prospects for an official market upgrade. As of July 5, 2026, the Vietnamese Dong remains highly stable against major currencies following a slight dip earlier in the week. The State Bank of Vietnam has kept its reference rate fixed, around 25,205 VND/USD, with the ceiling limit for commercial banks at 26,465 VND USD. To truly understand why these numbers matter and where the talk of revaluation or structural stabilization comes from, we have to look closely at the balancing act the State Bank of Vietnam is performing. When a central bank manages a currency within a strict trading band, every single dong shifted in the daily reference rate tells a story about broader macroeconomic currents. This past week saw a minor fluctuation, where the reference rate moved down slightly by a single dong, hitting that 25,205 mark, while major commercial institutions like Vietcombank and BIDV kept their selling quotes locked tightly near the top of the allowed asymmetric band. For investors, global traders, and the local business community, this stability is not accidental. It is the result of aggressive, calculated monetary defense and a clear fiscal roadmap designed to carry Vietnam into a premium tier of global financial markets. Vietnam's aggressive 10% GDP growth target for 2026 demands a highly sophisticated approach to liquidity. Historically, developing economies chasing double-digit expansions run the risk of overheating, sparking domestic inflation, and causing dramatic currency depreciation as import volumes surge to feed industrial growth. Yet, what we are witnessing in Hanoi right now is a complete subversion of that old boom and bust cycle. The central bank has deliberately prioritized a stable exchange rate corridor because they recognize that a volatile currency is the single biggest threat to foreign direct investment. By stabilizing the Vietnamese Dong, the state ensures that international tech giants, global electronics manufacturers, and massive infrastructure funds can deploy billions of dollars into the country without fearing that their returns will be eroded by overnight currency devaluations. This strategic baseline brings us to the core debate surrounding the Vietnamese Dong, the balance between steady stabilization and the long-rumored structural revaluation. In global currency circles, particularly among speculative retail investors, there is perennial chatter about a sudden, dramatic revaluation of the dong. Professional market analysts look at revaluation through a completely different lens, one focused on purchasing power parity, expanding foreign exchange reserves, and structural upgrades from frontier to emerging market status. The narrative of 2026 is less about an artificial overnight repricing and much more about an organic, fundamentally driven appreciation of the dong's true economic weight. As Vietnam shifts away from being a low-cost assembly hub toward becoming a high-value technology and green infrastructure powerhouse, the intrinsic value of its currency is fundamentally changing. The drivers behind this shifting baseline are multifaceted, starting with the sheer scale of international trade and capital inflows. In the first half of 2026 alone, Vietnam's fruit, vegetable, and agricultural exports rose by nearly 18%, while aquatic shipments climbed over 12%. This massive surge in trade, combined with record-breaking border trade volumes for premium agricultural commodities, represents a constant, heavy inflow of hard currency into the domestic economy. When a nation consistently exports more high-value goods than it imports, it creates a natural structural demand for its local currency. This massive dollar inflow provides the State Bank of Vietnam with the ammunition it needs to build up its foreign exchange reserves, giving the central bank an incredibly strong hand to defend the dong against speculative short attacks or global macroeconomic volatility. Simultaneously, the domestic banking sector is navigating complex regulatory adjustments that are reshaping how capital moves inside the country. Analysts note that the banking system is currently managing a tight loan-to-deposit ratio, which is tightly capped at 85%. To prevent liquidity crunches and to keep the credit engine humming, there is active discussion about a modest 50 basis point upward adjustment in the deposit interest rate cap over the coming months. What makes this fascinating from a currency perspective is how interest rate policy interacts with exchange rate management. In many developing nations, hiking interest rates is a desperate move to stop a tumbling currency. In Vietnam, any potential adjustment is a sign of immense domestic credit demand. Outstanding credit across the banking system has already surged past $798 billion, marking an 18.1% year-on-year increase. This is the sound of an economy operating at absolute full throttle, where capital is being efficiently routed directly into productive manufacturing, green energy plants, and high-tech industrial parks, rather than speculative real estate. To further anchor the currency's stability, the Vietnamese government has made profound institutional adjustments to domestic financial structures. One of the most critical moves in 2026 has been the sweeping reform of the internal gold market. Historically, during times of global inflation, domestic savers would dump local currency to buy gold, creating a parallel gray market that put immense downward pressure on the dong. By breaking up the rigid state monopoly on gold supply and liberalizing import mechanisms, the government has successfully synchronized domestic gold prices with global spot markets. This brilliant move has effectively neutralized gold as a competitor to the dong, channeling idle domestic savings out of unproductive precious metals and back into the formal banking system, which in turn gives commercial banks an incredibly stable base of liquidity. This brings us directly to the massive institutional reforms and the highly anticipated stock market upgrade that securities companies are pointing to as the real catalyst for 2026. Right now, Vietnam is working closely with global index providers like FTSE Russell to officially elevate its status from a frontier market to an emerging market. The implications of this upgrade for the Vietnamese Dong cannot be overstated. An emerging market classification automatically forces multi-billion-dollar global index tracking funds to allocate a structural percentage of their portfolios directly into Vietnamese equities. We are talking about an immediate wall of foreign capital waiting to cross the border. To prepare for this massive financial integration, the government has implemented deep institutional reforms, ranging from the implementation of strict electronic invoicing across all business sectors to a completely overhauled asset traceability system designed to meet premium international transparency standards. When you look at the total macroeconomic picture on this July 2026 afternoon, the pieces of the puzzle fit together perfectly. You have a central bank that is maintaining an ironclad grip on the exchange rate corridor, refusing to let short-term speculative waves disrupt the macroeconomic peace. You have an export sector that is completely defying global slowdown trends, continuously pumping billions of dollars back into the domestic financial ecosystem. You have a government boldly targeting a monumental 10% GDP growth rate, backed by genuine industrial production, a booming digital economy, and a massive pivot toward high-value technology manufacturing. This is why professional analysts view the stability of the dong not as a static, stagnant baseline, but as the launching pad for a major structural leap forward. Thank you all for tuning in to today's deep dive. If you want to stay ahead of the curve on global currency movements, emerging market upgrades, and the full macroeconomic truth behind the Vietnamese dong's historic 2026 development cycle, make sure to hit that subscribe button, smash the like sign, and turn on notifications so you never miss an analytical update. Drop your thoughts in the comments below. Do you think the State Bank of Vietnam can sustain this brilliant balancing act through the rest of the year, or are we on the verge of an even bigger structural currency shift? Let me know, and I will see you all in the next analysis.